For years, the world's largest companies have entered the public markets by going to Wall Street and going through a traditional IPO process. But lately, we've seen a string of some enormous firms choosing to SPAC instead of IPO. In today's video, we'll explain why. To start things off, we need to understand what is a SPAC. A special purpose acquisition company is a tailor-made blank check company that is optimized for reverse mergers, meaning they pull in an enormous pool of capital, often hundreds, sometimes even over $1 billion from institutional investors, with the presupposition that that money will be invested into a very large private enterprise. And by making that investment, merging together, that private company will become a publicly traded equity. So if you are a relatively large company, considering all your options, why would you choose to SPAC? Let's start off with speed. Speed. IPOs require that the company's executive team, along with their investment bankers, go on a roadshow to all the institutional investors out there, pitch the story, pitch the company, pitch its potential for the future.
Over time, with enough volume, we become profitable.
And drum up the hype required to have a strong public showing. They need those buyers to come in and buy the shares. It is an enormous task, can take 3 to 6 months, and much of the key executives' focus. If the company does not want to spend its time on that task, then an IPO is not for them. A SPAC has already done the raising from institutional investors on your behalf. The time to go public is substantially reduced. So for companies that favor speed, a SPAC may be the way. Number 2 is accessibility. The public markets are not particularly accessible, especially at the highest echelons, for companies that do not have substantial revenues, substantial profits, and proven technologies. Yes, you can hit the public markets as a small company, be a penny stock. Maybe the next Jordan Belfort will sling your stock to someone.
You finally found a broker on Wall Street that you can trust and who can consistently make you money. Sound fair enough?
Because SPACs have relatively lower costs to go public and can have brand name sponsors attached to them, Chamath, Ackman, Reid Hoffman, co-signing the company, the SPAC gets this company into public markets when a roadshow pitching institutional investors would likely leave a lot of them turning up their noses.
Our prices are the only thing keeping us in business.
They're actually putting you out of business.
Okay. Hold on.
And finally, certainty. When you go through the IPO process, you have a lot of uncertainty all the way up to the IPO date at what your company is going to be valued at, what type of liquidity you're going to be granting to your early employees and investors. Meanwhile, the SPAC process comes with a lot of clarity. Going into it, you will know exactly the amount of capital that will be added to your company's balance sheet and or the amount of shares that those investors are going to buy from the early employees, early investors, and management team. 2 big things will continue to drive the proliferation of SPACs. Number 1, as entrepreneurs, founders, executives of companies understand it better and where it falls in the context of different options for company financing. We'll see them continue to take that route. And the proliferation of viable, reputable sponsors. Some of these names, Bill Ackman, Chamath Palihapitiya, Reid Hoffman, and other bona fide, established entrepreneurs and or venture capitalists like Lux have been getting into the SPAC game with money from very well-established institutions and will continue to seek out companies that they can take public through these reverse mergers. If you're interested in the biggest financing deals in the entire world of business, then make sure you hit subscribe to our channel and ring the bell, because every single week we cover the biggest direct listings, SPACs, IPOs, and business stories of the day.